Shall we start? So, good morning, everybody. Please take your seat. We are trying to start in time, and a warm welcome at the Institute. My name is Marco Del Pante. I'm the Secretary General. It's funny. Okay, we can continue. So, again, warm welcome and a welcome to Isabel Schnabel, member of the ECB board. We are very, very happy to have her here. Not only that she wanted to take part of this conference organized by our two chairs, the Pierre Werner chair and the Tommaso Padua Schioppa chair, but also that she wanted to meet the local business community. That is something very important for us. First of all, I mean, speaking also on behalf of the Institute, because it's good for us to connect to the Florentine and local business community. Sometimes I have the impression that also in Florence, which is our hosting town, people don't have a clear idea about the Institute, no? Or they know that there's this European institution in the beautiful hills of Fiesole, but there's very little knowledge of what we do. So the fact that we are here, that there's a number of business men and women from the local community here is very positive, because you can have a glance of what we do here at the Institute. This institution was born in the 70s. Don't worry, I'll tell you just a few words. And we started with education, and the purpose at that time was to contribute by teaching to the creation of the European spirit. At that time, there were very few really international universities, and so there was the feeling that the European construction, which was taking place essentially in economic terms, should have been completed by an institution creating the European spirit, no? And that was done mainly through education. And then over the decades, this place opened its doors in 1976. So we will be celebrating our 50th anniversary in a few years. Over the decades, we have expanded our activity to research, policy, we call it policy relevant research, and to training. We have here the acting director of the School of Transnational Governance, George Papacostantino, and in Palazzo Bontalenti, in the town center, we perform training for professionals. But I mean, let's stick to research. We conduct what we call policy relevant research. And in the field of economic research, we have two chairs, and I'm very grateful to the two chair holders, Marco Buti and Giancarlo Corsetti, who organized this event, because this activity of the two chair is very much addressed to solve concrete policy relevant problems of the today, I mean, monetary integration in Europe. This is a good example from my point of view of what is the purpose of what we do here. The two chairs are also organizing now and trying to establish so-called EMU Lab, which is an initiative aimed at coordinating interdisciplinary project for the let's say for studying and reforming the European architecture in the field of monetary policy. So I will stay with you because I think that this is really a good means to show how the interaction of this institute and its activity can be of benefit for the local community. I think that the businessmen who are present here will enjoy the presentation and will have a chance of explaining what is the impact of the monetary policy of the European, of the ECB on the activity of their companies and societies. So I would give the floor to Eric Jones, who is the director of our Schuman Center, where the two chairs are located, who will tell you something more about the purpose of today's event. And then we can start with our conference. Eric.
No, thanks, Marco, and thank you all. As you all know from the start of this presentation, we're still only collecting the data that we'll use to replace our Secretary General with artificial intelligence. The role of the Robert Schuman Center is to take cutting-edge academic research and make it accessible and relevant to stakeholders in the public and the private sector. And that's really easy to do when you have a cutting-edge academic who is a policymaker in the public sector and who invites herself representatives of the private sector to have a conversation. So she basically has done our job for us just by being here. And we're extremely excited to benefit from that. We're excited to benefit from that for two very important reasons. The first is that the European University Institute started as an institution for training doctoral researchers to go into academe, but academe is not the only place that a doctoral training prepares you for. And we need to show, both in person and in analysis, what the kind of research that our students learn how to do is capable of accomplishing out in the real world at a time when things are highly uncertain, when the challenges that we face are completely unexpected, or even worse, when they're expected, but they're the things that we hoped never would come to pass. And so having someone here who can demonstrate to our students that there is more than just the academy, and that it's important to accept the challenges that that more represents, is absolutely vital. The second reason is that those of us who work in the academy have a series of questions that we answer and ask by instinct and training. What we're learning now is they are not always the right questions, that we need to get stimulus from outside the academy in order better to understand what problems need to be addressed, and to think outside of our disciplinary boxes in order to address those challenges. So this event is both instructive for our students and for us as faculty. We're extremely grateful to have Isabel Schnabel here, and equally, we're very grateful to have all of you here. And we hope that at the end of her speech, we can engage in a very active, stimulating conversation where the questions you ask may not be answered in the moment, but will serve as the foundation for our future research agenda. So thank you all. And with that, I'll hand over to you, Marco, in order to introduce our speaker.
Thank you very much. Listening to Marco and Eric, actually, I remember the final pages of Jean Monnet's autobiography, the memoir, saying that we have started from the economy, but maybe we made a mistake. He says, we should have started with culture and education. We are not going to change now the course of European history or European integration, but in a sense, the UI is a contribution to make the wish of Jean Monnet come through. Now, this is the inaugural lecture of the EMU Lab, so the Economic and Monetary Laboratory, that we have launched at the UI at the Robert Schuman Center by Giancarlo as Pierre Bernet chair and myself at Tommaso Padua-Schioppa chair. I mean, the idea here starts from a basic diagnosis. The debate is stuck on many issues, on several issues. So you take banking union, you take capital markets union, you take some sort of fiscal union, I put that in inverted commas, not to talk about political union. We see that, you know, the debate is clearly not going ahead as it should. So the idea of the lab is precisely to reignite a debate on this. Now, when you think about doing something as we are trying to do, then one has to ask the why, the what, the how, and the when. I think if you take all this, by and large, and I take the community of economists, and I'm not generalizing to all, but I would say there is a large agreement on the what. You know, I think on what to do, I think there is no major disagreement. There is an issue on the when, and here the wrong answer is to wait till the next crisis to act. But then I think where we really are you know, we have to put our intellectual capital is on the other two, which is the why to, you know, reconstruct and rebuild the case for European integration, the why, and the how. So, because, I mean, to provide the right incentives here is absolutely key to do, you know, to unstuck the debate, as I have said. And if you want to deal with the how in an effective manner, then I think you have to take a multidisciplinary approach. I think that's the spirit of what we are trying to do here. And there is a lot of potential, you know, here at the EUI. You know, we have the opportunity, unique opportunity maybe, to put together economists, political scientists, historians, lawyers, and you need this broad, you know, multidisciplinary approach to start to make progress again. And the idea of the lab is also to put together scholars, policymakers, you know, market participants, investors, also to have a broad approach there. And this is what we are trying to do today. And what we are doing today with the inaugural lecture is precisely that. Now, we have started with the EMU Lab. We had a first event on the 9th of January, which was, I think, a very high-profile event with Barry Eichengreen, with Adam Tooze, Martin Sambu, and others. We have the event today, and then a little announcement for the next events. On the next week, we are all welcome. Giancarlo and myself will give a seminar on the 20th on our paper on the 25 years of the euro. Then with that, we start a series of EMU Lab seminars and webinars. Then we are going to have on the 22nd of March, EMU Lab session on fiscal stabilization. And there, I think we have a stellar program. Olivier Blanchard is going to join us, Vitor Gaspar. I think we have, you know, all the major international institutions. And then still in the making on the 14th of May, so take note of all these dates, we have EMU Lab session on Capital Markets Union. So this is the program. Now, let me break what I consider to be a bad habit. And the bad habit is to say, our guest today needs no introduction, and then you go on for 10 minutes explaining what he or she has done in life. So I'm not going to do that, and I give the floor immediately to Isabel Schnabel, thanking her very much for having accepted to deliver the inaugural lecture today. Thank you.
Buongiorno. It's a real pleasure to be here at this beautiful place. I have to tell you, I feel very attached to Florence because I started my honeymoon in Florence more than 20 years ago. And so I love Florence. And this is why I'm not only honored, but also very happy to be here in Fiesole, actually. And it's a great honor to deliver this inaugural lecture of the EMU Lab. Let me actually congratulate you on the foundation of the EMU Lab, which is a very important initiative. It's important for Europe, and it's also important for the ECB, because what you are doing here and what you're doing more generally at EUI is precisely what we need. So we need the combination of really high quality research and policy relevant questions. And this is what you're doing here. And thank you very much for doing that. So today, I'm actually not going to talk about monetary policy. You may be surprised, but I'm talking about another topic, which is the euro area's competitiveness crisis, which I think is another very important topic that, by the way, also matters for monetary policy. And I want to discuss how to close the euro area's technology gap. So more than 30 years after its inception, economic and monetary union is widely seen as a success. It has steadily gained support among Europeans, and today nearly 80% of euro area citizens support the single currency. And this is a strong vote of confidence, and it shows that the euro is actually more than just a currency. Our monetary union has become a global leader in social protection, a pioneer in fighting climate change, and a guardian of free trade and democracy. But these values and achievements are being increasingly questioned and challenged in a world that is becoming less open, less stable, and less reliable. And to assert its role, the euro area needs to remain competitive. It must be capable of creating the sustainable growth that our social and economic fabric depends on. However, this capability is increasingly under threat. At the turn of the millennium, Europe was operating at the global technological frontier. But today, many euro area firms are laggards. Compared with many of their global peers, they invest less in both physical capital and research and development. And they're actually less productive. And today, I would like to explain the factors behind the euro area's competitiveness crisis, and I would like to propose some remedies to address its deeper root causes. And I will argue that our most potent weapon for enabling European firms to catch up to the technological frontier is to eliminate the remaining barriers to the free movement of goods, services, and capital in the European Union. European firms would then be able to compete and thrive in an environment of disruptive technological change where the winner takes most. Europe looks back on a long history of innovation and fundamental transformation. In the 16th and 17th centuries, the discoveries of Nicolaus Copernicus and Isaac Newton marked watershed moments for social and scientific progress. In the 18th and 19th centuries, the rise of industrial Europe laid the foundations for modern society and the ensuing significant improvements in the standard of living. After World War II, Europe once again became the world's engine of productivity growth. On the left-hand side of my first slide, I hope you can actually see it. You can see that in the 4 largest economies in the euro area, the ratio of labor productivity compared with that of the United States increased rapidly, soaring from 25% in 1945 to 100% in 1995, and thereby closing the productivity gap with the United States. And these gains were widely shared across euro area economies, reflecting the fast integration in trade and finance in the run-up to the establishment of the EU's single market, with new technologies spreading rapidly across borders. And you can see this on the right-hand side. So, going into the 21st century, Europe was operating at the global productivity frontier. Productivity growth was slowing over time, but that was to be expected as the distance to the frontier narrowed. But in the following years, the euro area took a different course and fell behind other economies like the United States. Between 1995 and 2007, annual growth in GDP per hour surged measurably in the United States, whereas it slowed and diverged in the euro area. By the time of the global financial crisis in 2008, euro area economies had accumulated productivity losses of some 20% relative to the United States, with the productivity ratio falling back to 0.8%. And the euro area has not been able to recover from this loss of competitiveness. Productivity growth has remained subdued, and this development was reinforced more recently by the repercussions of the pandemic and the Russian war in Ukraine. The dismal trajectory of Europe's productivity has been subject to much analysis. Most economists agree that European firms' failure to reap the efficiency gains brought about by information and communication technologies, in short, ICT, is one of the root causes. And this shows up in both the capital stock and total factor productivity. This slide shows that over the past 3 decades, a striking gap in the real IT-related capital stock has emerged between the euro area and the United States. Broad-based investments in ICT fundamentally transformed the US economy, and especially the services sector, as ICT became a general-purpose technology which radically changed the way many firms operated and served their customers. As a result, annual productivity growth in the services sector in the United States increased by 3.2% on average between 1995 and 2005, compared with just 0.9% in Europe. But even in the United States, the productivity boost driven by the ICT boom proved temporary. This slide shows that since the global financial crisis, productivity growth has been subdued across advanced economies, despite continued rapid technological change, including the rise of generative artificial intelligence. The potential causes of this slowdown have been discussed intensively and controversially. Some argue that the most recent technological innovations are simply less revolutionary than earlier inventions, such as the railway, electricity, or the telephone. Others claim that we have yet to see the full benefits of AI and other cutting-edge technologies, as history shows that technology adoption rates can be slow. In 1987, Bob Solow famously remarked that computers were everywhere except in productivity statistics. Empirical evidence supports this second hypothesis. It finds that although technologies developed at the global frontier are spreading across countries ever faster, they are spreading to all firms within an economy ever more slowly. Slow technology diffusion is also at the core of why firms in the euro area have failed to benefit from the ICT revolution. And two explanations have been identified in the literature. One is that the business environment in the United States made it easier or more pressing for firms to invest in ICT. Despite important progress on reforms in the wake of the sovereign debt crisis, product and labor markets in the euro area often remain heavily regulated. For example, many euro area countries set higher administrative requirements for startups than other advanced economies. High barriers to entry protect the rents of incumbents, reduce technology diffusion, and constrain the entry of younger firms, which are more likely to innovate. On the left-hand side of this slide, and by the way, you find all the slides on the ECB's website because I recognize that you may not be able to read everything. You can see that in the euro area, younger firms that survive are on average almost 3 times as productive as their older peers. Most of this gap can be explained by young superstar firms, which increase their productivity on average by around 100% per year. On the right-hand side, you can see that these firms invest more than their competitors, particularly in intangible assets, such as software and databases, and they use fewer and more specialized workers. The link between firm demography, technology diffusion, and productivity growth can be seen in the manufacturing sector in particular. The left-hand side of this slide shows that there was a marked decline in productivity growth of high-tech frontier firms in this sector during the past decade. This coincided with a measurable slowdown in business dynamism. The right-hand side chart shows that today, the average age of a high-tech frontier firm in the manufacturing sector is about 50% higher than it was before the global financial crisis, and about twice as high as that of their peers in the services sector. This lack of creative destruction is often associated with a lower level of innovation activity. Empirical evidence also shows that firm size is an important factor driving investments in ICT, as the fixed costs related to process reorganization weigh particularly on small and medium-sized enterprises. However, higher administrative requirements may prevent younger firms from expanding. In France, for example, and I know it's true in many other countries, several labor laws only become binding when a firm exceeds the 50-employee threshold. Such requirements have made it harder for euro area firms to grow to a sufficient size. This slide shows that in the United States, firms with more than 250 employees account for almost 60% of total employment. In the euro area, the share is between 12 and 37%. Similarly, the lack of external capital often makes it difficult for firms to scale up. In the euro area, venture capital investments are much lower than in the United States, so that many innovative companies hit funding constraints once they have entered the growth phase. And this may lead them to relocate to places where funding is more readily available and capital markets are deeper. Having young firms that are highly productive while displaying low productivity at country level means that a large part of our available resources is stuck in corners of our economies that are comparatively less productive. A large body of empirical evidence suggests, however, that broader business conditions have not been the only impediment to ICT-related productivity growth in the euro area. A look at US multinationals doing business in Europe illustrates this well. These firms have significantly higher productivity gains from IT than the European firms, the European peers, despite facing the same regulatory environment. And this seems to be because US firms consistently score higher in people management practices. The US management hypothesis rests on the observation that IT adoption requires complementary changes in a firm's organization to reap the productivity gains of digital technologies. That is, as the price of IT equipment falls and computational capacity rises, improvements in productivity mainly depend on skilled people using data, software, and new procedures that leverage these technologies. The experience of police departments in the United States is a good example. Higher IT investments alone had no statistically significant effect on reductions in crime rates or increases in clearance. However, when IT adoption was complemented by the introduction of CompStat, a management system created by the New York City Police Department, crime rates fell and clearance rates rose. And the evidence from the euro area confirms these patterns. The left-hand chart of this slide shows research by ECB staff, and it shows that only about 30% of firms, those closest to the technology frontier, manage to use digital technologies in ways that raise productivity over time. For most firms, investment in ICT has no significant impact on their efficiency. In other words, digital technologies require a large stock of human and managerial capital. In many euro area countries, however, a significant share of adults, in some cases more than a third, have not completed upper secondary school. And this is what you can see on the right-hand side. And such gaps in the education system can help explain why many firms have not been able to reap the benefits of the ICT revolution so far. Closing the euro area's technology gap has become more urgent than ever. Russia's war of aggression against Ukraine is weighing heavily on the price competitiveness of euro area firms. The left-hand chart shows that today, electricity prices in the industrial sector in the EU are almost 3 times as high as in the United States and more than twice as high as in China. And as a result, the production of high energy intensive goods is declining at a concerning pace, undermining the euro area's stronghold in traditional industries. And this is shown in the chart on the right-hand side. Energy from fossil fuels is bound to become even more expensive over time as carbon prices rise. This implies that the only way to sustainably regain competitiveness is to reduce our dependency on fossil fuels by accelerating the green transition. However, since high carbon intensive sectors such as mining, refineries, and air transport have so far on average been more productive than greener ones, the reallocation of production factors across sectors during the green transition will mechanically reduce aggregate productivity over the short run. Boosting technology adoption in less carbon-intensive sectors could help offset some of these effects. And by raising wages and reducing inflation, this could also secure public support for the green transition. Domestic headwinds are further aggravating the euro area's productivity malaise. 3 of them are particularly relevant. First, the euro area is facing demographic change of unprecedented magnitude. The left-hand side chart of this slide shows the latest population projections by Eurostat. The old age dependency ratio, that is, the number of people aged 65 or above, relative to those of working age, 20 to 64, is expected to increase on average from 37% in 2022 to 60% in 2070. The rapid aging of our society coincides with the shift in preferences, as more and more people prefer to work fewer hours. The right-hand chart shows that average hours worked per employee have been on a secular downward trend since the 1970s, mostly reflecting a decline in the numbers of hours employees desire to work. With fewer working-age adults working fewer hours per each elderly person, output per hour work needs to increase for our social system to remain sustainable. Second, as productivity gains from digitalization remain confined to a few highly innovative and productive firms, we are seeing a concerning trend in market concentration. The left-hand chart on this slide shows recent estimates by ECB staff that suggest that while the median price markup of firms has remained broadly unchanged over the past 2 decades, the upper tail of the markup distribution has increased considerably. Such winner-takes-most dynamics are mainly observed in the services sector, where the productivity gap between frontier and non-frontier firms has been widening rapidly. And this you can see on the right-hand side. This also reflects the fact that many laggards have failed to exploit the efficiency gains from ICT. The experience of the United States suggests that the rise of superstar firms such as Apple, Amazon, and Alphabet can have lasting macroeconomic consequences and can help explain several secular trends, including the fall in the labor share of income and the rise in income inequality in the United States. Moreover, to the extent that some monopoly rents are increasingly earned outside the euro area, such dynamics increase the dependency of domestic firms on third countries for the supply of technology, which is constraining strategic autonomy. Third, productivity growth is a key determinant of medium-term inflation and real interest rates, which means it directly affects the conduct of monetary policy. The left-hand chart of this slide shows that over the past year, we have made considerable progress in restoring price stability after the largest inflationary shock in decades. Raising our key interest rates was instrumental in curbing high loan growth that risked entrenching the adverse cost push shocks that the euro area economy had faced since 2020. But the right-hand chart shows that persistently low and recently even negative productivity growth exacerbates the effects that the current strong growth in nominal wages has on unit labor costs for firms. And this increases the risk that firms may pass higher wage costs on to consumers, which could delay inflation returning to our 2% target. And in this environment, monetary policy needs to remain restrictive until we can be confident that inflation will sustainably return to our medium-term target. The recent long period of high inflation suggests that to avoid being forced into adopting a stop-and-go policy akin to that of the 1970s, we must be cautious not to adjust our policy stance prematurely. Measures that help firms boost productivity growth directly support monetary policy in achieving its objective of securing price stability over the medium term. And such measures would also expand the future policy space for central banks if faced with new disinflationary shocks. This is because higher productivity growth pushes up the marginal product of capital and hence the neutral real interest rate, R star, which is the interest rate at which monetary policy is neither expansionary nor restrictive. New estimates show that an increase in trend productivity growth by 1 percentage point can increase R star by 0.6 percentage points. A higher R star would reduce the need to embark on unconventional monetary policy measures that often come with larger side effects. How then can we solve the euro area's competitiveness crisis? My diagnosis of the problem suggests that aggregate productivity growth depends both on how technologies are used and advanced at the firm level, the management hypothesis, and on how resources are allocated across firms. In other words, the broad business environment. And there are important interactions between these two factors. A slower technology diffusion across firms, as suggested by the divergence of productivity between frontier and laggard firms, boosts the gains that arise from reducing an efficient allocation of resources. These gains are estimated to be significant in the euro area. This slide shows, and you should look at the left-hand side bar, that in Italy, for example, it is estimated that aggregate productivity in the manufacturing sector could be around 15% higher if national frontier firms were as large as the global frontier benchmark. If these firms were empowered to scale up, aggregate productivity growth could rise significantly. And this is what happened in the United States in the 1970s and 1980s. Research shows that a substantial part of productivity growth in manufacturing during this period can be explained by output shifting from less productive to more productive firms. The European Commission recently presented concrete action points for improving competitiveness in the euro area, and it is working towards a regulatory framework for enhancing growth. In addition, Mario Draghi is expected to deliver a comprehensive report on the EU's competitiveness later this year. From a euro area perspective, I see three mutually reinforcing factors as critical for reducing resource misallocation and for promoting and easing the diffusion of digital technologies in the euro area. First, we need a regulatory framework that more strongly embraces and encourages competition. There is broad evidence showing that strict product market regulation, rigid labor markets, and excessive red tape have significantly inhibited the adoption of digital technologies in the past. Since the euro area sovereign debt crisis, many governments have made measurable progress in making their economies more flexible and less rigid. However, the momentum of reform slowed notably after 2012. And in an environment of rapid technological change, this slowdown has made existing regulation more costly, as the impact of regulations on economic activity is highly state dependent. For example, competition policies are typically less important in countries that are far away from the global technological frontier. During the 1960s and 1970s, Europe was able to catch up with the United States despite lower business dynamics. In today's digital world, however, competition matters significantly more than it did in the 20th century. Research shows that stronger competition is associated with significant improvements in managerial ability, which we have seen as key for reaping the benefits of digitalization. And to kickstart this virtuous circle, the cost of firm entry and expansion, as well as the cost of closing a failing business, need to be reduced. For example, in the euro area, it takes on average more than twice as long as in the United States, 2 years instead of 1, for creditors to recover what they are owed after a company defaults. Bolstering the Schumpeterian process of creative destruction has become ever more important after the pandemic, as government support schemes have led to fewer firms exiting the market during previous crises, although this process has started to reverse. Second, we need to foster integration in the euro area. Firms operating in larger markets can more easily build economies of scale and tend to be more innovative. The single market is our strongest weapon for combining our economic weight and allowing European firms to compete and thrive in an environment where the winner takes most. However, the level of European integration, especially in the area of market services, which account for around 70% of the EU's GDP, remains disappointing. The left-hand chart on this slide shows that intra-EU trade in services accounts for only about 15% of GDP, compared with more than 50% for goods. Similarly, only 25% of large firms offer cross-border online sales in the EU. For small and medium-sized enterprises, the share is below 10%. To a significant extent, this reflects remaining regulatory and administrative barriers restricting cross-border trade in services, with little, if any, progress having been made in addressing this in recent years. Our financial markets also remain segmented along national borders. The right-hand side chart shows that financial integration in the euro area has not increased from where it stood in the early years of monetary union. This contributes to capital misallocation and reduces the potential for cross-border risk sharing. Research shows that deeper and more integrated capital markets could measurably boost diffusion of technology. Increasing access to capital can reduce the distance from the technological frontier by 5 to 7%. ECB President Christine Lagarde recently laid out how important timely progress towards a true capital markets union is for succeeding in the ongoing green and digital transitions. Consolidating rules and market infrastructures and reviving the securitization market would go a long way towards reducing segmentation and improving access to external finance. Completing banking union is equally important. Banks remain the backbone of our economy. Yet, since the establishment of ECB banking supervision in 2014, we have made little progress in creating the conditions for banks to operate freely across borders. This slide shows the total EU cross-border assets held by banks, especially by our subsidiaries, remain far below the level seen before the sovereign debt crisis. Deepening our banking union requires two additional steps. One is reducing the regulatory impediments that continue to hinder cross-border consolidation and competition. These impediments include fragmented tax and insolvency regimes and limited cross-border fungibility of capital and liquidity within a single banking group as a result of ring-fencing measures by national competent authorities. As it takes time for such obstacles to be removed, a faster means of achieving this goal would be for banks to rely more extensively on branches instead of providing services through subsidiaries. In this regard, ECB banking supervision has already brought forward important suggestions for facilitating the use of branches. Further steps are completing the ratification of the amendment of the treaty establishing the European Stability Mechanism, ESM, and creating a European deposit insurance scheme. Regrettably, national sovereign safety nets remain the ultimate backstop for banks. This cements the sovereign bank nexus that led the euro area into a deep crisis more than 10 years ago. Progress on risk sharing through EDIS needs to be accompanied by stronger market discipline to mitigate adverse incentives and make risk sharing more politically palatable. Therefore, risk sharing and market discipline should be advanced in parallel. Third, we need to raise public investment, both at national and European levels, in order to deal with pressing structural challenges. The green transition, territorial security, digitalization, and growing shortage of skilled workers. Complementarities between public and private investments mean that capital deepening by firms alone will not be sufficient to overcome the euro area's competitiveness crisis. Public investment has been weak in the euro area for a long time. The left-hand chart shows that after the sovereign debt crisis, a visible gap in public investment opened between the euro area and the United States. Against this background, the ECB welcomes the recent agreement in the European Parliament and the Council on a new economic governance framework that attempts to balance the need to ensure debt sustainability against incentives for investments and structural reforms. The latter are essential for raising productivity and economic growth, and therefore also vital in supporting debt sustainability. Now, governments must take full ownership of the new rules. Besides consolidation efforts, this means meeting the reform and investment commitments made in their national recovery and resilience plans, which are at the heart of the Next Generation EU program. NGEU can play a significant role in overcoming the euro area's competitiveness crisis, as it allocates most of its funding to public investment, including in education and training. For the euro area, financial support offered by the national recovery and resilience plans amounts to 513 billion euros, or almost 4.1% of euro area GDP. The right-hand chart shows estimates by ECB staff, which suggest that NGEU has the potential to measurably boost productivity growth over the coming years. However, this requires full implementation of previous commitments. Reforms and investments are being actively pursued across the EU. My final slide shows that by the third quarter of 2023, around 500 reform-related milestones and targets had been assessed as satisfactorily fulfilled. At the same time, despite a significant catch-up in December last year, the latest evidence points to some backloading in the implementation of investment plans. For the euro area aggregate, the latest estimates by ECB staff indicate a cumulative shortfall over the period 2021 to 2023 of around 4% in relation to the total funding that was initially available. Next week, the European Commission will publish an independent evaluation report on the progress made on implementing investment plans so far. The delays highlight two potential areas for reflection on the way the Recovery and Resilience Facility is designed. One is the administrative burden. The RRF regulation requires member states to set up an effective control and audit system. Such a system is important for protecting the EU's financial interests, but anecdotal evidence suggests that this system poses a considerable challenge for national administrations, which has led to delays in payment requests. It is a trade-off that requires reassessment. The other area of reflection relates to the NGEU's ambitious horizon. All funds need to be tapped by 2026, the latest. While we have no time to lose when it comes to stimulating productivity and fighting climate change, rushing the implementation of investment projects could translate into supply bottlenecks, unwarranted demand-driven inflationary pressures, and the risk of selecting easy-to-fulfill projects that favor government consumption over investment. And these issues demand attentive contemplation, as we cannot allow Next Generation EU to fail. The stakes are simply too high, also for the ECB. With Next Generation EU, the euro area temporarily addressed three important gaps in its institutional architecture. It set up a central fiscal tool to provide stabilization through common resources, which supports monetary policy. Second, it led to closer integration in economic policy making by coordinating strategic investment decisions at European level. And third, it increased the liquidity of EU bonds and it deepened euro area capital markets, thus making progress towards the creation of a truly European safe asset. How effectively governments use the NGEU funds to make our economies fit for the challenges we face will therefore critically define the future path of European integration. Successful implementation of NGEU presents a unique opportunity to boost productivity, lay the groundwork for completing the euro area's institutional architecture, and make monetary policy more effective. So let me conclude. Nobel laureate Paul Krugman once noted, productivity isn't everything, but in the long run, it's almost everything. European leaders recognized this already more than 20 years ago when they signed the Lisbon strategy, but progress has so far been disappointing. Growing economic nationalization, threats to our territorial security, and a rising technology gap between ours and other advanced economies make the case for boosting the euro area's competitiveness ever more urgent. The responses to the pandemic and the war in Ukraine demonstrate that Europe is able to pull together when faced with adversity. Turning from laggard to leader requires initiating a virtuous circle between public and private investment on the one hand and productivity growth on the other. This starts with full implementation of previous commitments under the Recovery and Resilience Facility. Priority must be given to measures that strengthen competition, reduce bureaucracy, and stimulate further integration in product, labor, and financial markets. These measures will help channel capital and labor towards their most productive uses, challenging incumbents and removing barriers that are holding back young, productive firms from growing to their full potential. And importantly, Europe leading the way on productivity also helps the ECB to maintain price stability. Thank you very much.
Thank you very much, Isabel. Now, we'll have to see if what I said before, which is a broad agreement on the what, given the three-pronged policy agenda that you have laid out for us, whether this finds indeed a consensus of the audience. Okay, Isabel has accepted to take a few questions, so we have about 15 minutes before the conclusions of Giancarlo. So you are welcome to come forward. We have two mics here. Keep your remarks and questions brief and to the point. And introduce yourself when you take the floor, Marcello.
Marcello Messori, Schuman Center. Thank you very much for your analysis. I found your speech quite stimulating, and you offered us a number of hints to better understand why the euro area has an increasing technological gap towards the United States and China. Nevertheless, I would ask you to offer us some additional hints on two topics. You maintain that the size of the firms matters a lot. And according to the economic literature, the problem is not that firms start being small. The problem is the dynamics in the size. And from this point of view, organization of the firms matters a lot. And according to the literature, there is a complex relationship between the organization of the firms and the access to financial tools. Do you agree with this kind of analysis? And if I may, my second point is to better understand the relationship between wages, the reskilling of human resources, and technological innovation. You maintain that it's important to control the unit labor cost. Nevertheless, a compression in wages could disincentivize firms to adopt risk innovation. What do you think about this topic? Thank you very much.
Thank you, Marcello.
Should I answer me?
Please.
So two obviously very important questions. So I think I agree on your first points. I mean, we have, of course, the financial system in the euro area is, of course, very different from that in the United States, let's say. I mean, we are a very bank-based system. And the question is whether banks are able and willing to finance very risky firms. And I think the experience shows that we do have firms that get the funding initially. But the problem is that once they grow, they do not find the funding to really becoming large. And so, for example, I mean, one one important issue for venture capitalists is that, they want to put a lot of money into the company, but then at some point they want to exit. And they want to sell the company to the markets. But if you don't have a deep capital market, that is very difficult in Europe. And so in this sense, and I think there's actually broad agreement on that, it would be useful to have a more diversified financial system than we have at the moment. I mean, the banking system is, of course, working fine for certain purposes, but for other purposes, other types of financing would be useful. And this, of course, then also where capital markets union comes in. And I mean, it's quite striking. I find that our supervision is completely fragmented, so it's still happening at national level. I mean, the market infrastructure is completely fragmented. And I mean, it seems that everybody kind of agrees on, bringing forward capital markets union. But then when it comes to the details, they're very protective of their national supervisor, for example, and they're not willing to give that up. And so I mean, in the end, I think it's clear what to do, but the politics is not as simple. So on the second point, I'm not entirely sure whether I understood the question, but of course the productivity growth a higher productivity growth makes it possible for wages to also grow more strongly, without giving a rise to higher unit labor costs. But what we have now is kind of the worst of all worlds, where the wages grow nominally, and of course it's clear why they do, because there is this catch-up process that still needs to happen in response to the sharp decline in real wages. But at the same time, productivity is even falling. There are different reasons for that. I mean, one argument is labor hoarding, which has happened quite a bit. It's also related to the composition of the workforce. So on average, people were integrated into the labor market, and the labor market has been quite resilient. We're on average less productive. We've seen a shift from private sector employment to public sector employment, and we've also seen a sharp increase in sick leave, which also then weighs on productivity. And of course, what we would like to see is, in the process of what you mentioned, like reskilling and better education and so on, of course, wages should grow and have to grow, but also because productivity is becoming stronger. And then, that's also not an issue for inflation.
Very much. I think what also Marcello meant is that the arrow going from wages to productivity, and not only from productivity to wages. That's what I'm the exeget of my co-author. Okay. Now we have Isabel. Maybe we couple of questions. Okay, we have George, Vivian, and then I take one from this side.
Thanks very much, George Papakostantino from the School of Transnational Governance. One comment and two brief questions. The comment has to do with diffusion and adoption. You made very clearly the link to productivity growth. This has been demonstrated even back in the 90s at the OECD using input-output data. We found that link very strongly. I wonder, however, how useful it is to do the separation between diffusion and innovation. The innovation literature seems to show that as product cycles become shorter, the link between science, discovery, and diffusion becomes, again, shorter. I like much more the connection to capital markets, for example, and the lack of deeper markets in Europe as an impediment to productivity growth than to say something on diffusion. I think these two discussions somehow need to be integrated more. That's my comment. Two quick questions. The first one, in one of your charts in the beginning on the US-EU productivity gap, there is this kink around 2000, which is, of course, the introduction of the euro. So could you clarify if this is connected to higher productivity growth per hour in the US or lower one in the EU that drives the increase in the gap? And the second, on competition conditions, there's a lot of work, Thomas Philippon, for example, that shows that there's a robust conditions of competition in Europe vis-a-vis the US, where competition has been less robust in the previous years. How does that come into the argument that we are falling behind because of lack of competition? Thanks.
Thank you so much for your comments and really phenomenal explanation of, Vivian Schmidt, Schuman Center and Boston University. Great comments. And I think we've got the economics and but I want to pick up what, thank you, what Marco Butti asked in terms of how. So this is more political questions. And you talk, my question would be, are you asking for us to go beyond the RRF? Seems to me the call for more investment suggests that an EU level fiscal union is key here. You also talk about the importance of banking union and the EDIS, and you mentioned risk sharing and market discipline. And so when we talk market discipline, I'm immediately thinking, well, does this mean, given what's being discussed now, does this mean going back to the pre-COVID fiscal rules? Which would mainly mean austerity for many of Eurozone countries. So what does that do to investment? And I suppose the last question would be, where does the ECB stand? What can it do? Thank you.
Vivian, okay, we take one. Yes, please define. Okay, come forward. And then we give the floor to Isabel.
Can you hear me? Yeah. Okay. Santi Piñol from M&I. I have two questions. The first question is like, you said that small Italian firms have like a productivity potential growth of 15%. I wanted to ask if that 15% it's all internal, or some of that it will be the incremental of other firms or firms from other countries, if you have a number of that. And the other, it's on the fiscal capacity too. So if I understood, I don't know if you are in contact with Mario Draghi on the competitiveness report, and if that would be one of the conclusions. But the question is that from an ECB point of view, what would be an appropriate balance sheet for increasing the fiscal capacity of the ECB? And now that we are more than in the Ecuador of Next Generation EU, is it working? Because you said that we cannot fail in this project. What's the mark on the program right now that we have passed the Ecuador? Thank you.
So thank you very much for these excellent questions. So I would, on your first question, I would have to look at the numbers. My guess would be it's both, but I would have to check. I haven't looked at the separate series. And on the second question, I think it's actually it's a good point, because I think you're right that the US is often not as competitive as it seems. And I mean, we do know that also, I mean, and I mentioned it briefly, I mean, they have this huge concentration, and they have these superstar firms. So the difference in competition is probably not the main factor to explain the difference between the two. I think it's a very valid observation. So so that means that if they had more competition, they would grow even more strongly, potentially, if we believe the competition story. So Vivian, Okay, so now your question on fiscal union. I mean, maybe first a fiscal capacity. You probably know that the ECB has always been supportive of a fiscal capacity in the euro area because it would kind of constitute the counterpart to a single monetary policy. And I mean, one of the reasons I would argue why we came relatively well through the pandemic is that we at least temporarily created such a fiscal capacity. Of course, politically, it's much more difficult than that because, as you know very well, many stakeholders made it clear that this is a one-off thing. And this is precisely why, it has to be proven a success to be repeated. This is why I think this is so incredibly important. So I made this comment, and you rightly picked it up, about the combination of risk sharing and market discipline. And some of you may have noticed that this was a motive of a report that I also contributed to a long time ago in my previous life, which was called the 7+7 report. It was a report of a group of 7 French and 7 German economists who kind of tried to make proposals for how to move forward European integration in a way that would take into account all of the concerns. I mean, of course, some of the concerns are precisely what you mentioned. I mean, the austerity concern. I mean, we've seen that actually that hasn't worked so well. But on the other hand, there's also the concern about moral hazard, right? So when you have any type of insurance, let's say, you also have an issue of moral hazard. And what we tried back then is to kind of, and we went through all the different parts like deposit insurance, fiscal rules, and so on. And we kind of tried to find a way how to take into account all of the concerns and actually bring them together. And I personally, and that is not an ECB view, it's my personal view, I believe that is still the way to go if you want to find a political agreement. Because, I mean, both types of concerns are valid. And you kind of have to bring them together. And it certainly does not mean to go back to austerity. And I think this is also, if you look at the design of the new fiscal rules, I mean, that was one of the main concerns, that we make sure. I mean, one of the problems was that austerity meant that, in particular, the investment expenditures were cut. And this is something that is not even good for debt sustainability, because it doesn't help economic growth. And I think this is by now very well understood. Okay, so the ECB role, I mean, our main role is, as you know, to keep prices stable over the medium term. That's pretty important. I mean, some people claim that, the sharp rise in interest rates is harming investment and so on. I always said that, the best environment for investment is a stable environment, an environment where you can rely on, more or less stable prices and so on. And I think that is our main role. But of course, we do play an important role also in these European debates. But of course, we are more observers, and we can, give speeches like this one and, spread ideas, express views, but the decisions are taken by others. So on your questions, I mean, I would have to check again the paper, but from what I see, it's actually an effect that comes on top. But I mean, one has to look at the econometrics. But in the end, of course, I mean, if you want to have a dynamic business environment, it's probably not the case that everybody grows. But I mean, you have to have new firms that grow, but you also have to have some firms that are less successful and leave the market. I mean, this is part of the efficient reallocation of resources that you need. So it's, I mean, overall, it's clear it's beneficial, but normally not everybody is going to succeed and not everybody is going to gain. I think that is clear. So your second question, I was a bit confused because so the fiscal capacity is not related to the size of our balance sheet. I mean, these are very different things. I mean, we are doing monetary policy. We are not doing fiscal policy. We are very clearly trying to keep away from that. That's not part of our mandate. And so these are, I would say, these are very different questions. On Next Generation EU, how to measure success, I mean, there is already now an evaluation process ongoing. Of course, it will matter to see how the money was actually spent, whether the money was spent. And ideally, we would also see the impact on productivity. But of course, that it's relatively hard to do over a short time frame, and we may only be able to see that over the longer term. I mean, not all investments are good. I mean, investment, we always tend to believe investment is always good, but of course we know there can also be unproductive investment, and it has to be seen whether everything that was done was as productive as we hope.
Thank you very much, Isabel. Okay, we take the final flash question, but only if it is from the right gender, to rebalance here the dramatic imbalance that the accidental imbalance. So, okay, we do not have the right gender. So, okay. Oh yes, we have one. Okay, we have one. Okay, we have the. Okay, we allow the final two. Okay, we take. And then we take a gentleman on the back.
Good morning, everybody. I'm Zalba Bocconi, PhD candidate and European Court of Auditor grant holder. So, okay. So my question is about, let's say, the size of NGU, because you correctly mentioned that it will help to close this gap. However, many studies already mentioned that it is not enough, both for the green transition and for the digital transition. So I was posing this question a few weeks ago to the Italian and the German ambassadors, and they mentioned, yes, but also the private sector should do something to close this gap for the transitions. And as we have many representatives of the private sector here, my questions for you is also about that. If you could give your point on this. Thanks so much.
Final.
Okay, my name is Jeremiah Nyambinya, Policy Leader Fellow at the School of Transnational Governance. My question is related to critical minerals availability and how the EU could work on, as a case study to the public investment you proposed, on alternative critical minerals. And just to give an example, OpenAI, the company that is behind ChatGPT, is currently looking for $7 trillion to invest in the supply chain of chip production. So that is about more than 50% of the GDP of the Euro area. So that public-private investment, would that role be part of what the ECB could encourage?
Okay, Isabel, final word.
Yes. So on the amount of Next Generation EU, I would probably say that at the moment, it's probably even a bit too much. So the countries find it hard to spend the money. But of course, it's not enough to manage the green transition and all the kinds of transitions that we're facing. That's obvious. And this is also why the question, of course, is going to come up, whether there will be any type of follow-up of such a program. But you made a very important point, which is that the private sector plays an important role. And of course, it plays a much larger role than the public sector. I think it cannot be that this is all financed by the public sector. The most has to come from the private sector, but there's a lot of empirical evidence that there are these complementarities between public investment and private investment. And I mean, some things are pretty obvious, like infrastructure, right? You will not have private investment if you don't have an appropriate public infrastructure. And so there are these very strong complementarities, and therefore the public investment can also help to kickstart the private investment, which is absolutely needed and in huge amounts. So on your question, actually the availability of critical minerals is a very important issue going forward. Also for the green transition, and we know that certain minerals and metals are going to be needed in huge amounts. And we also know that the geopolitical situation has become much more difficult, and that some of those minerals are very concentrated in only a few countries. By the way, we are also looking into this from an inflation side. So some time ago, I gave a speech on how climate change and the green transition could affect inflation. And one of the arguments there was that the green transition in itself could raise inflation, because you suddenly have this huge demand for critical minerals, and the supply is rather, I mean, it's limited, or at least it takes time until it is expended. I mean, we are already seeing that it's expended. I mean, the main thing that we, of course, learned over the past years is that we have to diversify also, that we cannot rely on single providers. And that is one of the, that's very important. But you also mentioned, of course, that there are like big private players with enormous amounts of money who may try to control those resources. And these are issues that, I mean, governments will need to deal with. And I would say this has a pretty high priority.
Thank you very much. So a round of applause for Isabel. Thank you very much. So we are coming to the end. We have the final comments by Giancarlo.
We are way over time, so I'll be extremely brief. You may wonder why a lab talking about European monetary integration starts with a reflection on productivity, market structure, supply, demographics. And I think the answer is it's because this is what the future of monetary integration is about, which is not only understanding the context in which it operates, but also understanding how monetary, fiscal, regulatory policy can actually contribute to address, to unleash the potential of Europe. Being an academic, I insist on the fact that those are topics that at the same time contribute to social welfare and make your career as PhD candidates fly. Martin de Ridder, I mean, I'm new to this, so I'm quoting my former Cambridge student. Martin de Ridder, now at LSE, contributed a fantastic paper on what it means intangible, scalable technology from the 70s to today in terms of changing productivity, market structure, business context. This is an important input to understand that there is also a dynamic of TFP going from heavy investment to what the venture capitalists call the killer zone, in which the big companies kill all the incumbents. Lucas Freund, now choosing between US prestigious university and European prestigious university, wrote a paper on the micro origins and macro implication of teamwork. And this is where the point is. The superstar firms think in terms of teams and understanding what teams are the winner is very important. Lida Smikova, looking at the strong difference in the size distribution of firms across Europe, presents a very interesting interpretative framework to understand why there are so big imbalances in Europe between the North is a surplus, the South is. So all this has very strong policy implication. And not to mention Lucas Nord from here, who are, by the way, the recipient of the Young Economist Award in the ECB, who took seriously the problem of market structure, the interaction between demand and supply in the firms, at the retail level. Why am I saying this? Because all these people are very successful, Oxford, Penn University, and I think it was very successful also in being taken very seriously at the European Central Bank level. So I've done my duty as an academic advisor. Let me finish quoting the last question that Marco did not mention, the who, how, when. Yesterday night we talked about who. This is an important question in Europe. Who are the leaders that can understand this and have the capacity, intellectual capacity, first of all, and the political courage to pull up the burden, to push Europe forward. On this note, again, I was inviting you to applaud Isabel, but we already applauded her. So I guess I should stop here, inviting the representative of the very lively business environment and people here in Florence to have a meeting in seminar room 2, right, Marco? So just after we close down. Thank you for thank you everybody for time.